Hey guys, in this video series we are going to see about what options are and why you should consider them to get a consistent profits from the market. So let's get into the video. Options are pretty much like insurance that is paid to your car. That is, when a damage occurs to your car, you get some money to minimize the losses. Except in this case, here there is no car, it is for the stocks. To understand this, let's take an example. Let's say you bought a stock at 500 rupees and due to some reasons, the share price has gone down to 400 rupees. That means you have lost 100 rupees. So let us take another scenario where you have got option contract from a person stating if the price goes below 500, you can use this contract to sell it at 500 rupees to that person. So you get this contract by paying a small amount as premium, just like insurance. In this case, let us assume that 20 rupees is your premium. That means from the last case, if the price goes down to 400 rupees, you say that you want to use the option contract and sell to that person, so that in this case you have lost only 20 rupees. That is only your premium amount you have paid to that person, whereas in scenario 1 there is a loss of 100 rupees. This is known as hedging. Remember that options have expiry date, so that after the date the contract is invalid. So the perspective of both persons are opposite. One person is so confident that the price will rise up, so he is ready to bet by getting a small amount as premium. Then other one who has invested is like cat walking on the wall, not much confident. He is not worried to pay a small amount as a premium. Options are mainly used for hedging and trading purposes. So the above one is hedging. To understand about trading in options, you need to understand two concepts: put option and call option. So put option is when the price drops and you have a contract stating you can exercise your contract at a higher price, just like the above scenario. Buying at 500 rupees, if the price goes down to 400 rupees, then using the option to minimize the loss. But in this case, you don't have the shares. Instead, you have the 20 rupees put option contract. And if the price goes down, the value of the option rises. So let's say the put option value is 50. Do you think the investors are ready to pay? Obviously, in order to minimize the loss. So in this case, you have not bought any shares. You have only bought and sold the put options and made a profit of 30 rupees. Then what is call option? It is contrast to the put option. That is, if the price goes up, let's say 600 from 500 rupees, you can buy at 500 rupees with a call option by paying some premium amount to the contract. It is used in case of shorting. Now that you have understood the basic about options, let us see deeply how to use options specifically for trading in part 2 of this series. So subscribe and press the bell icon to get notified when I upload the part 2 video. And lastly, go watch our technical analysis video that will be very much helpful when it comes for trading.